was a great quarter for markets, many equity gauges putting in double-digit returns in Canadian dollar terms. And all this happened as some of the worst case fears around tariffs began to recede. And at the same time, a cooling economy, cooling economic data brought rate cuts back onto the horizon. Of course, we saw the Federal Reserve, the Bank of Canada actually cut rates again in September. Our expectation is that markets will probably continue to climb that wall of worry as we move forward from here, because again, we're just in that zone where the economy is cooling just enough that we're beginning to see some additional stimulus, but it's not quite to the point where we're concerned about a recession quite yet. Thinking about key risks, though, is really watching for that. Looking at the labor market that, like I said, is so far showing cooling trends, but we're paying very close attention to leading indicators around the labor market that might point to something a little bit worse to come. Again, so far our base case is that we're still in that Goldilocks scenario of a cooling economy, but one that's not ready to tip into recession. That is the key, though. Where are the labor markets really going to level off at this point? So bonds are in a little bit of a sweet spot right now. They're offering some pretty good yield. So despite cash rates being cut over the last couple of quarters, last couple of years even, a steepening of the yield curve has meant that longer term yields have stayed somewhat more elevated. So you're still getting some pretty good yield in the bond market. At the same time, if our base case that we just talked about, that the economy looks to be holding up well, if that doesn't turn out and we do see some more recessionary forces playing out, you're going to get some downside protection with your bond portfolio, as those yields will then fall and bond prices will rise. So it's an interesting time for bond investors, after the experience of 2022, where of course we saw bonds put in double-digit losses as yields moved significantly higher. Many investors have shunned the bond market. They've moved to cash, where again, in that period of time, you're getting some really good yields in cash, but cash yields have been falling. It's really a good opportunity at this point in time, for all the reasons we talked about, for investors to start reconsidering the bond allocation in their portfolio. So the Granite portfolios have really benefited from a theme this year where we've seen the breadth of participation across markets, across geographies, across individual securities and sectors as well, really broadening out, right? And this is after a couple of years where there's very narrow participation. It was really the US equity market, and it was really just the very top of the US equity market with those magnificent 7 stocks leading the way higher. With our very broadly diversified global approach within the Granite portfolios, and again, our use of active management, which can really benefit from when there's a breadth of performance across different stocks and some varying performance as well, we're seeing a greater drive towards the outcomes for those Granite portfolios. So that's been a big benefit in our overall approach. From a tactical perspective, we've benefited from tactical positions in gold. It's been one of those assets that's had great resilience against some of the volatility that we've seen this year, but also some, we think, secular themes around investors of all types kind of broadening their exposure to different currencies, to different markets, and gold now fits kind of that category as an additional reserve currency for many investors. We continue to hold gold as a tactical position in the portfolios. So if the economy remains resilient and markets continue to push higher, the Granite portfolios are going to benefit from what we believe will be a continued expansion around that participation across different geographies, across different sectors, individual securities, allowing that opportunity for active management to outperform as well. So, again, that a lot of the themes that have worked so far this year in an upside scenario, we think will continue to play out, playing well for the Granite portfolios. Risk to the downside, like we talked about, primarily would be around if the labor market and other economic indicators begin to slow more markedly. That's where the fixed income allocation within our portfolios will really begin to benefit. That tactical position as well that I talked about within gold, another risk mitigator at the same time. We also haven't talked too much about tariffs. So tariffs at the current level, so while not as bad as the worst case scenario that we were experiencing in April of this year, we don't think we'll have as much of a broad macro impact. But from the bottom up, when you consider the impacts to individual companies, it's going to be varying. Certain companies are going to be hit quite hard by tariffs. Others will be more flexible to pass costs on to their consumers or to pivot their supply chains and their ultimately their customers to different geographies. That sort of bottom-up company by company perspective is best implemented through some very strong active managers. Again, something that we employ quite extensively within our portfolios.